What is a hard money loan in real estate? By the end of this video, you'll know exactly what a hard money loan is. You'll learn how it works, and you'll learn when to use it. And also, how to avoid the common mistakes that new investors make that cost them thousands. If you've been looking into flipping houses, you probably heard the term hard money loan, and you're saying to yourself, what exactly is that? I have used hard money loans to fund tons of deals. In this episode, I'm going to break down how they work, why they exist, and more importantly, how to use them the right way. If getting the money is what's been holding you back, well, this tool might be the thing that opens up everything for you. That is, once you understand how it really works. So what is a hard money loan? I like to say it's not by a guy named Guido the Killer Pimp. It probably used to be back in the 70s, but that's not the way hard money works today. The hard money term has stuck with it because it costs more than a traditional bank when you go out for a mortgage for a home. Hard money lenders are investors that pool their money together and create a company that loans money on real estate. Now, you're going to pay higher rates for that. It's a short-term investment. You're going to pay points and higher rates than a normal bank, but normal banks won't lend to you. These hard money lenders are willing to take a risk on you, and it's more of an asset-based lending program. Your credit does play a factor, but the main factor is, does the deal support this loan? If the deal is bought cheap enough and supports the loan, then you can take money from a hard money lender. One of the more important things is it's fast. You can usually close within 2 weeks. And they're pretty flexible as well. They want to loan money. That's their business, is loaning money on real estate. So start to have good hard money lenders in your toolbox. So why is it perfect for flippers? Number one, it's designed for short-term deals. Remember, a traditional bank loans money for 20 or 30 years on a piece of property. Well, if you hold your flip for 20 or 30 years, you're doing it wrong. This is going to be some property you're going to own for maybe 6 months' time. That's what you want to be in and out of a flip for. And most banks don't want to loan money on short term. There's no money in it for them. But hard money lenders are willing to loan money on short term. You can make interest-only payments on the loan until it comes due. And you can get that loan closed very quickly. If you get into trouble, they will allow extensions in most cases. You're going to pay for it, but they will allow extensions if your deal goes longer than you initially expected. So what do these hard money lenders actually look for? They want to know that you have secured a good deal in real estate. They want to make sure you understand your numbers, you understand your renovation numbers, you understand what you're going to sell it for, and you understand your exit plan so they know they're going to get their money back. They do check your credit. If you have a credit score maybe 500 or 600, well, you're going to pay a little more for that money than someone that has a credit score of high 6s or 700 or 800. But learn how to buy properties at a deep enough discount so it protects everybody. The deeper you buy it and the safer they feel, the better rates you'll get as a person borrowing money from a hard money lender. Many times they're going to require a personal guarantee from you on that loan. Or if you don't have very good credit and the deal's a little bit shaky, they might require an outside asset that you own so that their interest is protected in that property. So what can you expect in regards to terms and fees? Typically, I've seen interest rates from a hard money lender anywhere from 8% to 16%. You might say to yourself, oh my God, that's way too much money. Well, I want you to focus on the deal and the money you're making, not how much the money costs you. Because the more flips you do, the cheaper your money will get. You have to start someplace. Usually, they'll charge you points. Now, points are 1% of the total mortgage. If you borrowed $200,000 from a hard money lender and they charged you 2 points, then it would be 0.2 times 200,000, or $4,000 in points you'll pay just for the privilege of borrowing money from them. That's really how they make their money. They'll usually loan around 65 to 70% of the ARV, so that's of the total value of the property when it's completed. Usually 70 to 90% of the purchase price they'll loan you, and anywhere from 70 to 100% of the renovation costs, and that'll be given to you in draws as you complete work. You're going to have to pay fees every time they send an inspector out to inspect your work. That might be a couple $100 for every time they do it, but it's something you should be aware of. And sometimes they have minimums. So if you take a loan out that's a 6-month minimum loan, well, if you finish that house in 3 months, good for you. That's awesome. Bad news is you're paying the lender 6 months interest even though you only borrowed it for 3 months. Still a good deal for you, but again, you should be aware of it. So how should you approach your first hard money lender? Well, if you've ever seen Shark Tank, they'll tell you, don't go on that carpet unless you know your numbers. You want to show up knowing exactly what you're going to do, what you're going to pay for that house, what your renovation costs are, and what is your exit plan. Most hard money lenders have a questionnaire you're going to fill out that gives them all those answers so they can help determine if they want to loan you money or not. Again, you'll have a conversation, you'll explain your deal, you'll explain your exit strategy. Confidence goes a long way with a hard money lender. They want to feel like their money is secure, just like you would. So here's some common beginner mistakes. I mentioned it before, but I want to say it again because it's important. A lot of people say, I'm not going to pay 15% on that loan. That's ridiculous, because you're trying to compare it to a 30-year mortgage that your bank would give you at 4, 5, or 6%. It's not the same thing. It's comparing apples and oranges. They're not even in the same family. So make sure you understand, don't walk away from the deal. Sometimes you have to lose the battle to win the war. If you still could make $50,000 on a flip after paying a hard money lender 15%, if you don't do that deal, give me a call because I'll do it. The other mistake I see is new investors will overestimate ARV and underestimate repair costs to try and make their deal look sweeter. Look, hard money lenders are smart investors. They're going to do their own underwriting and make sure the deal works for them. So make sure you know your numbers. It'll make you look a lot more credible as you start. So if you're going to use hard money, you have got to get your numbers right, especially your renovation costs and your after repair value, because that'll determine how much you can actually pay for the property. So go watch our video, how to evaluate a flip deal like a pro, and I'm going to show you how to evaluate rehab costs step by step so you can make smart offers, you can borrow confidently, and always protect your profit. Link is right here in the description below.